presentation contains current opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and thank you for joining us today on the Compact Market Crap Weekly Update for April the 28th, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, and thank you for joining us today. Let's start, first of all, quick update. Whenever you want an update on this, all you have to do is go to compact.com, click on Insights. You can also subscribe to this channel, and whenever we post an update, you'll be notified, and you can listen and watch at your convenience. Also, if you need help with your portfolio, send us an email at invest@compact.com or do it the old-fashioned way. Call us at 800-388-9700. Let's start with the numbers, Javaid. What happened last week? Not a lot is going on in the markets.
Yeah, market seems to be taking a little bit of a breather, has just been on a tear throughout the entire month of April since we've had a little bit more of kind of cooling of tensions within the Iranian conflict. S&P was up 0.56%, Dow down 0.4%, Russell up 0.37%. I do want to highlight the Russell. I know I've been kind of a bugaboo on Russell for
you've
quite
always
some
said no,
time.
but look at it for the year.
Yeah, Russell for the year is up 12.67%, probably one of the best sectors up so far this year. You compare that to the S&P, only up 5% this year. I think some of that has to do with Russell being a little bit more focused U.S. domestically, not so much globally affected, etc. You look at IFA was down pretty big last week, down 2.7% and only up 5.66%. So these are these big kind of global companies domiciled in Japan and Europe, etc. They're up, just a little bit more than the overall S&P 500. So I think the Iranian conflict is having some issues, clearly on developed markets, but then at the same time, you look at emerging markets. They were up 0.86%, and they were up 15% so far year to date. So emerging markets have really been the big benefit factor. I think emerging markets, what we're seeing there, I was looking into the numbers in a little bit greater detail, they're seeing a lot more earnings revisions and growth. So there's earnings, as we've always talked about, earnings are what drives stock markets in the long run. And basically emerging market earnings have been really kind of been revised up and continuing to be revised up. Also, I think AI, to a bigger degree, is going to really help benefit, I think, emerging markets more than any other global economy. Global economies going forward, as they're able to really kind of maybe skip a lot of steps and implement AI directly. And that can lead to a lot of those emerging market companies that might not have the workforce to really supply a lot of that knowledge growth. They're able to just jump straight into using agentic AI and AI to really start to generate some profits and grow and grow
very similar to cellular. A lot of these countries didn't have any phone lines,
Mm-hmm.
and they didn't have any phones. But then cellular came along, and they just
jumped. They never built the phone infrastructure.
Phone infrastructure, and it went straight to cellular phones. Now you look at the emerging markets. People do a lot more on their phones in emerging markets.
Mm-hmm.
They pay bills, they do all kinds of stuff in emerging markets. NASDAQ also up 1.51%,
Yep.
and up 7% for the year. So we've come back, but I think the market is waiting and watching. Just like everybody's on hold to what happens to the Strait of Hormuz, what happens to the Iranian situation, it's sort of on hold. It's a wait and see attitude. It sees who can endure more pain. That's really where we've come to. Can the world economy have the Straits of Hormuz closed and 20% of the world energy supplies not coming out of there? Or Iran, which now we've blockaded, so they cannot export any of their oil, so they're not getting any money from the global economy. So it just depends on who can sustain more pain. And I am concerned that the Iranians don't care about their people. They shot, thousands of them in January and killed their own people, so they don't really care about their own people. The IRGC, that's the Iranian Revolutionary Guard Corps, that's now supposed they're basically in charge. The generals are running the country. All they want to do is hold on to their power. And they don't care about their people, so they say, hey, people are going to starve, so be it. So it's okay, we'll have to wait and see. Or the global economy, with I think a lot of these, especially the Asian countries that get 40, 50, 60, 70, 80% of their energy from through the Straits of Hormuz, they have a problem. So which one will give in first is the question now, and where do we go from here? That's really the question, and everybody's sort of in a wait-and-see mode. So is the market.
Well, but one of the things I'm watching really closely is, traditionally when we look at oil and oil futures, they've been going up over the last couple of weeks, and that's been the catalyst for the market to the downside. And they've been going up, and the market hasn't really gone down. It's kind of, a little bit more of a sideways trading range over the last week or so. But I think that the pressure is mounting. And now that we potentially are breaking out, we'll show the DBO chart in our technical analysis section for the weekly update. I personally believe that the U.S. and the global economy has more to lose than Iran, in the sense that I think politically, and this is what I said a couple of weeks ago, economically, I don't think the oil has a huge impact. In fact, some break-even analysis where if gasoline prices get to $5 a gallon, nationally, if you're here, if you're listening in California, you're already there. Yeah, sorry, but we're used to that. But we're talking nationally. If gasoline prices get to $5, that wipes out the entire benefit of all the tax refunds that everyone's getting right now. So, and we're kind of headed in that direction, with DBO headed that direction. Now, it's not the end, it's not a recession, but it's just wiping out that stimulus that was being built into the equation. And particularly, we're looking at GDP growth. We'll look at GDP growth. We'll get that number tomorrow. It's coming in about 1%. I mean, 2% if you include some of this government, the makeup for the government shutdown last quarter. But when you look at all the really kind of driving forces of the U.S. economy, it's only at 1%. That's another. I think it's a blessing and a curse, because 1% is not robust where we have to worry about inflation. But at the same time, it's not robust growth.
It's stall speed. It's not. You're not falling. You're not going negative.
Yeah.
But it's not growing. Basically, that's what I call stall speed, where we are just sort of stuck. And that's the way the market is stuck. It's not going up. It's not going down for the last week or so.
Yeah.
Just sort of hovering. And to me, it seems like it's losing a little bit of momentum. I'll talk about that when I take a look at the charts. I talked about it last week. So we'll talk about that. Energy was the big winner. It was a big loser last week. It's the big winner this week. Oil prices have come back up.
Yeah, and oil futures have come back up, so energy has definitely rebounded. And I think there's almost a barbell type of approach going on, where people are buying energy in case things get worse.
Right.
and at the same time, we see the other sector up most is technology, up 3.1%. That's kind of if things get better.
Right.
And if everything really normalizes. So you're kind of seeing this barbell approach. Also interesting to see healthcare really taking a big hit down last week. Financials also down. So it's just I don't love kind of all this price action. I think we're seeing, earnings are still coming in really robust. We're going to get all the mega tech earnings this week. So we'll see how that looks like. But, semis, even today, today was kind of a little bit of a reversal in the semiconductor market. I think it was up 18 days consecutively.
Right.
And when you start to look at semis as a component of this technology sector, it's grown. I was looking at the numbers. Semis now represent 42% of the tech sector.
Wow.
You go back 10 years ago, semis were only 10% or 15% of the tech sector. So semiconductors and the AI trade, right, the hardware and software, the hardware component has really gone up, and then we've seen it to the detriment of technology, and software companies have been coming down. And so you look at the PE on software companies, those were 54. The forward PEs on software companies were 54 back in 2021. Now they're back down to 23. So they've been cut in half as there's a lot of disruption. And so there's still a lot of good earnings there. The biggest earnings are coming from the tech sector. But the question is are we going to be able to maintain those earnings going forward as these companies are investing a lot? And that was the news today. I think it was the chief financial officer of OpenAI. She came out, there was some discussion, and who knows about the reporting from the Wall Street Journal, but she is saying we might have to start tightening our belt here a little bit to ensure that we're on a path to profitability in some time within the next couple of years. You just can't keep, any of us, whether you're a corporation or whatever, yes, if you're making a lot of money, you can spend more money, but if you spend more than you make, eventually...
Unless you're the U.S. government.
Well, yes, the U.S. government...
Then you can just print a whole bunch more.
But in many ways, we are all the U.S. government. in the sense that you probably have treasuries in your portfolio and money. We're all part of the U.S. government. We pay our taxes and we get the benefits, and hopefully that continues. Clearly, if we had a default in the U.S. government, we'd have a lot bigger issues. But we're not seeing any sort of sovereign default worries, across all the different markets. So that's good. But I think it's something, when you see a higher concentration of one particular sector, it can be ripe for a little bit of clearly of a cooling off, and I think that's what we're starting to potentially see within the technicals as well.
Oil has come back up. I mean, it was up last week, it's up again, and it's just coming back and hovering right around this $100 a barrel mark. So we'll see which way it goes, and it'll be the next couple of weeks are going to be the deciding factor. If the Iranians come back to the table and say, okay, we'll open the Gulf of Hormuz and we'll give up our enrichment program, everybody's happy. So far they say they want to open the Gulf of Hormuz, because they want to sell their oil and make hundreds of millions of dollars or billions, and they don't want to give up the nuclear bomb, which is the whole thing that this whole war started about, is them giving up the nuclear weapons, or their enrichment program. So it's next couple of weeks are going to decide.
I think we're going to be in a stalemate for a long time. And so then I think that's why the oil futures are starting to go up. And that's why I look at DBO, not just, so here you have the oil price and you also have gasoline. I think the gasoline is also the big piece here to look at. We were at $2.81 at the beginning of the year. We're now at $4.04 nationally for gasoline prices across the country. As I said, as we get into about 4.5 to 5, that's really, people are going to start, squawking a little bit. And the one thing I didn't mention earlier, what I think is the biggest impact of this is not necessarily economic. I don't think this is going to put us into a recession, cause earnings to just, go away, et cetera. I think the biggest change is going to be political. With oil prices going up, and if inflation's running a little bit higher, clearly Kevin Warsh is going to be confirmed. He's not going to be able to cut interest rates until oil prices come down. And I think what we're starting to see is politically, now if you look at some of the betting markets, it's about 80, I think almost 90% probability that the Democrats are going to take control of the House. And now that probability of the Senate is also starting to creep up, potentially in favor of the Democrats as well. And I think the market somewhat likes that, in the sense that if they get a divided government, that you have the White House, you have the administration, but that's being offset by the Democrats. I think the market likes the fact we got what we wanted out of the Republicans. We got the tax cuts, and that's now encoded for the next 5 years. That's great. All this other stuff, this tariffs, these wars, all these other things that are going on, we don't like this so much. And if we're going to get a little bit more of the Democrats in control, or at least to counterbalance the Republicans, I think the market looks at that actually favorably. Now, of course, however you fall politically, you're going to have an opinion.
I just don't know about that, because I think, again, the administration now is cutting rules, is cutting taxes, is doing all of that stuff. And the Democrats might decide, hey, we want to tax people more. And if you start taxing people, that's always a negative.
I don't think they're going that direction. I think they know taxing people, if they're going to tax people, they're going to tax some billionaires and do that type of thing, try to engineer some money that way. They're not going to redo the big tax cuts that were just done, because that's just going to be political suicide for them. So we'll see. But once again, none of that's going to get passed anyway, because it's going to be vetoed by the president, and there's going to be whatever majority it is. It's going to be a very slim majority.
It's not going to be a supermajority where they can override vetoes and things
correct.
like that. That's going to be.
So it's just more of that. You have just more balance. And I think, once again, the market got what it wanted. It wanted tax cuts. The market, and when it comes to politics and markets, the market wants two things: lower taxes and free trade. And we almost shot ourselves in the foot with all the tariffs, but we reversed on that, where it seems like now with the ruling from the Supreme Court, that's also been ruled back, right? So the tariffs seem to be off the table. Yes, now we have a geopolitical conflict, but that's somewhat, we're less susceptible to that having an economic impact. So really the thing that the market cares most about when it comes to politics is taxes. And taxes are basically, pretty set for the next 5 years.
Interest rates were up sharply, just like the market, really no change. We went from 4.26 to 4.31, not a big change there at all.
Yeah, and bonds were down slightly last week, but high yield down less. We'll look at our relative strength chart on the high yield chart in our technical analysis section. Still, it's actually at record highs, so still looking very positive from an economic perspective.
This is an interesting chart of the week. We put this out. By the way, if you can't see it, go to our YouTube channel, compact.com/YouTube, and you can see this. We saw how much the prices went down on everything or different asset classes when the Iran conflict started. Gold was down the most, down about nearly 10%. U.S. stock market was down nearly 7-8%. But now it shows what has happened. Recovery all the way up, 4.3%. The U.S. stock market was second best. The best was emerging markets.
Well, emerging markets on a net, but yes, they've recovered the most. If you look at net emerging markets, but it's really been the U.S. that have recovered the most.
Right.
Since all of this started. So that's why I like global. I like going international. I like even mid and small cap companies with growth opportunities. I don't love the indices. I think the better way to get access to that small and mid cap growth story and a backdoor way in international is looking at some of these private equity interval funds. And I think those are better ways. You're buying more dynamic companies that are private, and you get access to that asset class. And if you look at the returns on a lot of these interval funds, I know there's been a lot of talk about private credit. I've been going deeper on that, but I think private credit is fine.
Right.
I don't think it's systematic. And I think also what private credit is now, you just mentioned, the administration has deregulating a lot of things. You look at corporate banks, their revenue or loan growth is up 7% year over year. That's the most it's up in almost 3 years. And so I think private credit now has the banking system as a little bit more of a competition, and that's where you're also seeing some weakness there. And competition in a way is not the end of the world, it actually makes you stronger. So private credit's gonna have to up its game over a period of time.
Retail sales continue to go up 1.7% month. People are still spending.
Yeah, if you look at consumer confidence, it's down.
Right.
But when you look at people they're still going out and spending. And I was even looking at, there's a control retail sales. This is kind of like core CPI where you strip out some of the stuff.
Right.
So if you take out gas, autos, and building materials, spending is still up 0.7%. So even spending went up a lot because people are just spending more money at the tank,
Right.
At the pump. But also if you look at all the other things, people are still spending and feeling good. Job market's looking good. So as far as the consumer, and that's seen, we're seeing that reflected
Still holding up.
in
That's
earnings
really,
as well.
Yeah, earnings are just spectacular.
Yeah.
They're really, really doing well. So companies are making money. A lot of data coming out this week. You've got first quarter GDP coming out. I think that'll be sort of discounted because of all the shutdown and all of that, and then the comeback from the shutdown and so on and so forth. But I think the big one to watch would be the PCE, the personal income. That's what the Fed watches.
Yeah, and I think that could have some movement on the bond market and interest rates. So I'm going to be watching that really closely. That's on Thursday. Fed's talking on Wednesday. I don't think they're doing much. This is potentially Jerome Powell's last, Fed conference before Kevin Warsh gets nominated. I think here relatively soon in May. And then you have a lot of central banks. Bank of England, Japan. I think even European Central Bank is all happening this week. I don't think anything's changing because of where things have gone up, but you get a little insight into what they're thinking in terms of, are they even getting close to potentially raising rates, which I know is not on the table, but
right.
How much dissension are you seeing within the groups? And I think that sets the table for then how much the new chairman of the Fed is able to really kind of push the committee to try to cut rates, which is what the president wants. I think it's going to be tough, and we're going to get a lot of insight into that this week.
I would not be surprised if he cuts rates.
I know he talked about
I've
it.
talked
Cut
about
rates,
it,
but
and
then
I've said that for the last 6 months. I've said what they're going to do is cut interest rates and cut QT. They're going to, just increase QT.
And the market might be rallying because of that.
Yeah,
right? And lower rates, and says, it's good for a while until interest rates really, the bond vigilantes come out and interest rates spike. But
Right.
if it kind of feels like it's maybe just an appeasement, to the president for nominating him, then market's going to like that as well. That's the other thing market likes, of course, not controlled by politics. We like to think the Fed's completely independent, but lower interest rates, the market likes that a lot.
Looking at the technicals, we're right at the top of this range. This is really getting, this was the projection for the market from beginning of the year when we made the new all-time high. It gives us a Fibonacci projection, which was right here, 71 and change to about 71.75. And today we were as high as 71.52. We closed right around there at the highs. So we'll see if we can get above 7,200. Then we have to start looking at the weekly chart, which gives us a target right around here, which is about 7,300, 72.75, somewhere another 100 points. So
Yeah,
but
which is nothing.
but what I'm concerned about is these 5 waves.
Yeah, the fifth wave tops. And this is something we talked about last week. And fifth wave tops are times when you just want to make sure that this is the time that you have the right allocation for any sort of bigger pullbacks or corrections, because a lot of the easy money has been made. The market's gone up a lot, and so some of the strategies that I've been talking to clients about is hedging strategies where you don't actually have to sell anything. Everyone thinks, oh, I gotta, in your IRAs, it's really easy to maybe do some rebalancing. You should maybe consider doing that, particularly with interest rates where they are. But if you're in your brokerage accounts, you might have huge unrealized gains. And if you sell that, you're taking a 20% haircut right off the bat for paying capital gains. And so you have to make up for that hit at some point. Well, an easier way is potentially look at hedging your portfolio. You can do option collar strategies. So that's where you're selling calls and buying puts. So you're selling calls, you're giving up upside, and then you're getting that money, and then you're using that to buy insurance. It actually doesn't cost you anything besides having to monitor that and knowing how to manage through that. And so this is where a really good, I think, financial advisor can help you potentially reduce the risk in your portfolio without having a big tax consequence. And so if you'd like to learn more about these strategies, we're implementing these strategies and talking to prospective clients, particularly who have concentrated portfolios. I'm speaking with a prospect tomorrow. 85% of their money is in Apple. And so, it's been great. He's made a ton of money. He's not a really sophisticated guy. He just bought Apple because he worked, I think he worked on the iPod commercial when it first came out a long time ago. So he said, this thing looks pretty cool, bought some Apple, and now he's got couple $1 million because of it, which is wonderful. It's the beauty of capitalism. But now is potentially the time where, as you always say, you get rich through concentration, you stay rich through diversification. And it's not what you make, it's what you keep. And so this is kind of maybe one of those times you really want to start to put in some strategies that don't cost you anything, but you got to have the knowledge and the wherewithal and the monitoring capability of how to manage an option collar strategy. And we have that expertise, of course, here at Compact. And if you'd like to learn more about that, just shoot us an email at invest@compact.com or give us a call at 800-388-9700, and we'll put together a proposal for you.
Now's the time to do it, folks. When markets have already gone down, they're down 20%, 25%. We're in a bear market. It's over. At that time, you're just sitting there and praying. That it'll come back, and it will, but it might take 4 or 5 years for you to come back. And if you're 70 years old, 65 years old, you want to enjoy this money so that you've made in the markets. It's not what you make, it's what you keep that counts. You've heard me say that for 30 years. Now's the time to give us a call. We'll set up a strategy. We'll sit down with you. We'll look at your risk profile. We'll look at what you're trying to accomplish, and we'll develop.
I would just like to say, if you're 70 and you're watching YouTube, I mean, kudos to you. So yeah,
hey, we do. We watch. Older
true.
people do watch YouTube. Okay, I don't know about TikTok and Instagram yet, but that's the other story. This is the high Nasdaq target on the upside, starting to break out to the upside. And if we do on the dailies, then we go to the weeklies. But we also very
kind of hit it.
Very, very close to the weeklies, 25,000, 25 and change. We're at 24.6.
So talk to me a little bit about the extended fifth, right? So we're in a fifth wave. Right. So if we get above these projections that you're putting out on the market, then it extends.
Exactly. And that's what they're way up here.
So how do you project that?
It's a Fibonacci projection. You get a projection from third wave, the first projection, then you get an extension of 1.38%, then 1.62%, and so on and so forth.
So you got percentages above that, kind of that projection, that early high we had in maybe February.
So I'm going to put these out and next week, and you see the charts on the projections. If we do get above these initial Fibonacci projections, then I'll put out the extensions on each one of these, and you can see that. Small caps continue to move higher. But again, wave 5, and a lot of this is wave 5. As you've heard me say for years and years, everything moves in 5 waves. 1 up, 2 down, 3 up, 4 down, 5 up. Once you get to the 5th wave, we get an ABC correction. That's what happens. Here we came down 5, made a 5th wave top. This was in 2022. Came all the way down into 2023. And then we started a wave count to the upside. This is the weeklies from 2023 all the way up to here for 3 years.
Yeah, and then it feels a little bit like 2021. You know, we're starting to get that fever around IPOs, right? And everyone's excited of, oh, I need to go and I got to get into all these IPOs. You don't understand, these guys are getting out. Like the smart money's getting out, it's not getting in.
When do people do an IPO? They're selling their shares to the public.
Yes.
That's what's happening, folks. That's what an IPO is.
You got to keep that in mind.
Yeah, this is the international stocks, but they look better. Third
Yep.
wave. They look 3, not a 5.
I think global stocks, and particularly emerging market stocks, and we've done a lot of due diligence here within the investment committee on what type of ETFs you want to buy. There's some that are emerging markets, but I think also ex-China. There's some that focus more on democracies and things like that, particularly around emerging markets. So we have some good ones. If you'd like to kind of learn more about what that exposure looks like, then give us a call, shoot us an email. We're happy to kind of walk you through where we're seeing some opportunities within.
Here's the
emerging
daily
markets.
chart of the.
This is a chart I said. If we get above, I'm surprised. We got above 2150 today.
Yeah.
Right, and we closed. I think we close.
2159.
Yeah, and the market's just saying, okay, eventually I think just because the president seems like he's not going to start, if he starts bombing Iran again in the infrastructure, and then they start them bombing the infrastructure of the Middle East, and it just codifies these higher oil prices for a while. If he, I think, decides that he's just going to continue with the ceasefire, oil prices are going to put more pressure, but it's not going to be, they think it's going to be at least temporary, because eventually there's going to be some sort of resolution.
Somebody's going to give in.
But if he, if whatever, the Iranians escalate, right, or the United States, which I don't think the U.S. wants to escalate at this point, because they're realizing, hey, specifically politically, the Republicans are realizing they're in a tough spot here and they're not quite in control of the situation. It's going to have some impacts. But clearly the oil market, like I remember looking at the chart when it got to those lows, right, around 1850, 19, we got to get, tangibly below that before we can say this thing is really kind of done and
this
dusted.
This looks like an
behind us.
island bottom. You see it gap down and gap right back up, and that's scary. And now I'll put out the projection, but if we broke out above this high that we had made on DBO, and we made a new high today.
Yep.
So it's getting a little tricky, folks. I think still we're going to stay here unless there's an escalation.
Yeah.
If there's escalation, we start bombing, the Iranians start bombing the rest of the infrastructure in the Middle East, Oman, Qatar, UAE,
And I think it could
Arabia.
be, it's going to be worse, because then, now you're actually taking out infrastructure.
Exactly. You're taking out the oil facilities, producing facilities, which you can't reopen then. You've got to rebuild them. And that'll take years.
5-6 years.
And
Yeah, it's
so
gone.
we've got, even if they open the Gulf of Hormuz then, the
doesn't
Straits of Hormuz, doesn't matter, because the oil refineries and oil fields are destroyed. So you have to rebuild them, and it could take years to do that. Then oil prices skyrocket and stay there. They're not coming down.
And so that's why I think as long as this DBO chart is kind of, clearly making new highs, but even above these elevated levels, you want to maintain your risk, but I wouldn't be, even on the dips, really adding a lot of risk here until we get some all clear of where this thing is headed. And then you can see here on the weekly, I guess you added a weekly chart as well, this is a third wave.
Yeah.
Yeah. So that's
But
not
this
good.
is, look at this, it went just ballistic, straight up.
Yep.
This is like one of those missiles going straight up. We need to see, we could get a pullback. And if we do get a pullback, and then we just maybe
kinda
use up
choppy.
a lot of the energy, don't get a fifth wave, we hope. Treasuries they came down. Now they're back up, the 4.35. If you get much above here, 4.5%, that won't be good.
Yeah, I think we get the PCE number on
Thursday, I believe.
on Thursday. So I think how the bond market reacts to that, and all of this Fed speak this week from all the central banks, I think is going to be. I think it's a big week for interest rates, because I think if interest rates go higher from here, You start get above that 4.4. It's kind of we get into that danger zone.
Yeah, 4.4.
And so if we get kind of back into that 4.4 area or anywhere higher than that, I think you have your catalyst for that a little bit of a correction, potentially back down to maybe 60, maybe down to the 200-day moving average.
Yep.
Was kind of what I was looking at back
on
the dailies.
On the dailies, on the
S&P.
S&P. So here we're looking at 3, but as I said last week, we've used up so much of this upside energy. I don't think we make a 5th. We've gone back and forth here. I just think we're bouncing around here in gold. And
And I think gold, we talked about central banks are liquidating their gold. They were accumulators of gold. Now they're liquidating it due to the conflict. And clearly, if DBO is going higher, telling us the conflict's not ending anytime soon, I think there's going to be more mass liquidations of gold so they can continue to protect their currency and provide for their economies. Yeah.
Here's your favorite chart, the high yield against the government bonds.
Yep.
High yield is the red line, and the government bonds are the green line. As long as this is going more, doing better than this, it's a positive sign for the economy. But you can see for the last few days, this is a daily chart sideways.
Yeah. So this is a chart going back 2 years, but you can see the relative strength is still looking good.
Right.
And I think, generally the economy, I don't think we're in for any sort of big recession or, things like that. But because the earnings estimates continue to rise and they're really high, it doesn't take a lot for us to maybe miss some of those earnings expectations and for us to just see a correction within the stock market, right? It's similar, I want to say 2000 to 2002. The economy wasn't that bad in 2001 and 2. It was just that the stock market got a little bit ahead of itself, got a little bit too hyped, and it needed to correct. I don't think we're going to see that scope because these tech companies are making oodles of money as in profits. Compared to 2000, they were just completely speculative. But I think you just got to be ready for that. And once again, no gradual, no all in, all out moves in your portfolio, but potentially gradually, just taking a little bit of chips off the table, hedging a little bit. You're not selling, you're just giving up a little bit of upside.
Right.
The market continues to still go up, you'll make money. You won't make as much money, but in case it goes down, you're going to be really appreciative that you have those hedges in place.
Again, folks, if you want this update, just click on the subscribe button and you'll be notified every time. If you need help with your portfolio, send us an email at invest@compact.com or give us a call at 800-388-9700. Those are our thoughts. Those are our observations for this week. Again, now's the time to rebalance, folks. Make sure you're in the right balance in your portfolio so you don't get unbalanced if the volatility comes back. Those are our thoughts. Those are our observations. We will be back with you next week. Until then,
Good trading.
This presentation contains the current views and opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.